All right, so in our last video, we are going to be talking about other from AGI deductions. So these particular from AGI deductions are different and separate from the itemized and standard deductions. So the first one we will talk about is the deduction for qualified business income. We talked about this one briefly in chapter 15. And some important things to note for this deduction are the qualified business income deduction is limited to qualified trades or businesses. It excludes specified service trade or businesses, except for taxpayers with taxable income below $197,300 or $394,600 for joint returns, or $197,300 for married filing separately. And this deduction is subject to a wage limitation and a taxable income limitation. And then, like we also mentioned in chapter 15, the QBI deduction rate is 20%. So remember, 20%. Other types of from AGI deductions that are new with the One Big Beautiful Bill Act that was enacted in 2025 include the following that we see on the slide. And we'll just touch briefly on each one. And again, I'll write some highlights or some notes that will be helpful to keep in mind for these new deductions. So, the deduction for qualified tip income. This allows taxpayers to deduct up to $25,000 of qualified tips. And this deduction is subject to a phase out for taxpayers with modified AGI above $150,000 or $300,000 married filing joint. $25,000 with phase out. Next, we have the deduction for qualified overtime compensation. This allows taxpayers to deduct up to $12,500 or $25,000 for married filing joint of qualified overtime compensation. This deduction is also subject to a phase out. And this phase out is for taxpayers with modified AGI above $150,000 or $300,000 married filing joint. $12,500 with phase out. Next is the deduction for qualified car loan interest. So with this deduction, taxpayers can deduct up to $10,000 of qualified car loan interest. This deduction is also subject to a phase out. And this phase out is for taxpayers with modified AGI above $100,000 or $200,000 of married filing joint. So $10,000 phase out. And then the last one is the deductions for seniors. So under this deduction, taxpayers that are 65 or older can claim a $6,000 deduction and a $6,000 deduction for their spouse that is 65 or older. This deduction is also subject to a phase out, and the phase out is for taxpayers with modified AGI above $75,000 or $150,000 married filing joint. So $6,000 plus $6,000 for spouse with phase out. All right, so on the next couple of slides, we are gonna work a couple of practice problems, one for QBI, and then another one for one of the One Big Beautiful Bill Act deductions that just came up. So that way you can see the mechanics of the problem and how they work. All right, so for our QBI example, Courtney reports taxable income this year of $169,622. And they provided some extra information that it was a $207,000 AGI less $37,378 in itemized deductions. Before the deduction for QBI, and she has no capital gains and $700,000 of qualified dividends included in her taxable income. Assume that Courtney has no other from AGI deductions that would reduce her taxable income. Her architectural consulting services generate $18,000 of qualified business income, a $241 deduction for self-employment taxes, and she paid no wages in this business. Let's also assume that Courtney's condo rental is considered a trade or business, which generates $5,000 of QBI. What is Courtney's deduction for QBI, or qualified business income? So we are going to start this problem by looking at our qualified business income. So in the fact pattern, it tells us that her architectural consulting services generate $18,000 of qualified business income. And we are also supposed to assume that the condo rental generated $5,000 of qualified business income. So then if we add those two numbers together, so 18,000 plus 5,000, that gets us $23,000 of qualified business income. From here, we have to take into account any self-employment tax deductions. So in the fact pattern, it tells us that there is a $241 deduction for self-employment taxes. So then if we subtract that $241, so self-employment tax deduction, that gets us to $22,759, which is our base for the QBI deduction. If we multiply this by 20%, that gets us $4,552 as our QBI deduction before any wage limits. So before wage limits. So now the wage limit for QBI is 50% of wages paid. So in this particular problem, the wage limit does not apply because Courtney's taxable income before the QBI deduction is less than $197,300. And so just for reference, because we will need this number later, Courtney's taxable income is the $169,662, and then we have to back out the $700 of qualified dividends. So off to the side here, so taxable equals 169,622 minus 700, which equals 168,922. So since our wage limit doesn't apply, or that number is 0, now we will want to compare our QBI deduction before the wage limit, and then the number if there were 50% of wages paid if that limit applied. And whenever we compare those, we want the lesser of those two if the wage limit applies. If it does not, if that limit does not apply, then we will want that QBI deduction before the wage limit. So we will want this number here. Then from there, we need to determine what our taxable income limit is. So this is where calculating our taxable income will come in handy. So if we take our taxable income, so the $169,622, and then subtract out the $700 of qualified dividends, if we take that $168,922 and multiply that by 20%, that will give us a taxable income limit of $33,784. And so now we want to compare our QBI deduction before the taxable income limit and the taxable income limit and figure out which number is the lower number, and that is the number we will use for the QBI deduction. So if we compare 4,552 and 33,784, our QBI deduction is the 4,552. Alrighty, this next example problem is going to look at one of the new deductions that has come about from the One Big Beautiful Bill Act. And we're going to look at an example for the qualified tip income deduction. So assume Courtney has a nephew, Jordan, who works in New York City as a waiter at a 5-star restaurant. In 2025, Jordan earns a salary of $30,000 and received cash tips of $47,200 that were properly reported by his employer to the IRS. Jordan files married filing jointly with his wife, Juanita, who earns a salary of $240,000 as an investment banker. Assume Jordan and Juanita's modified AGI is $317,200. How much can Jordan deduct as a qualified tip income deduction? So to start this problem, let's find our qualified tip income. So if we look in the fact pattern, it tells us that the tip income was $47,200. So $47,200 is our starting point. Some things to keep in mind to help us solve this problem. the maximum qualified tip income deduction is $25,000. So that's our max deduction. And since the problem tells us that Jordan files married filing jointly, the phase out threshold for married filing joint taxpayers is $300,000. Married filing joint phase out. So if we take our qualified tip income and compare it to the maximum qualified tip income deduction we are allowed to have, we will take the lesser of those two numbers. So in this case, when we compare $47,200 to $25,000, the maximum deduction we could take is $25,000. So max deduction we could take in the problem, it tells us that Jordan and Juanita's modified AGI is $317,000. And so this is important to know, because now if we compare that to the phase out threshold, we're gonna have to perform some phase out calculations since we're above the 300,000. First, let's calculate how much excess modified AGI we have over the threshold. So the way we would find that excess modified AGI, the 317,200 from the fact pattern, and subtract our phase out threshold of $300,000, and that gives us $17,200. So excess modified AGI. Then for the phase out, we calculate the number of $1,000 increments above the phase out threshold. So what that means is we will take this 17,200 and divide it by 1,000, and we round down. So then whenever we do that, that gets us 17 $1,000 increments. From there, we take that number of increments and multiply it by 100. So if we multiply that 17 by 100, that gets us $1,700. And this represents the reduction of our maximum qualified tip income deduction. So this reduces max qualified tip deduction. So then if we take our max deduction of 25,000 and then subtract our reduction 1,700, that gets us a qualified tip income deduction of $23,300. So qualified tip income. All right, guys, that concludes this video, and I will see you guys soon.